If you were allocating capital today, would you rather put into one brand with one outcome, one market, and one revenue stream, or into a portfolio of brands, each generating recurring royalties, each scaling independently, and each compounding over time? Because that decision alone is the difference between building income and building real enterprise value. I'm Justin Kaiser, co-founder and CEO of Empire Franchising, and I've spent the last 24 years building businesses, structuring equity deals, and scaling franchise platforms, including taking my own franchise brand from 0 to over 100 franchise locations before an exit. Here's what I've learned along the way, from both the operating side and the investing side. The highest level players in this game don't think like operators. They think like capital allocators. They don't ask, how can I grow this one business? They ask, how do I deploy capital across multiple assets that produce recurring revenue and equity upside? And that's exactly what a multi-brand portfolio strategy is built around. It's not about building more businesses. It's about building a structure that produces multiple streams of royalties across multiple brands with shared infrastructure and aligned incentives. Because when you look at this through an investor lens, a single brand business, no matter how good it is still concentrated risk. One brand, one industry, one leadership team, one execution path. And if any of those variables break, your entire outcome is impacted. When you allocate capital across multiple franchise brands, each with its own growth curve, each with its own operator, and each producing recurring royalties, now you've created diversification. And now you've created stability. And more importantly, you've created multiple shots on one goal. This is why private equity doesn't buy one company and stop. They build portfolios, because portfolios smooth out the risk. It increases predictability and creates higher overall returns. And franchising, when structured correctly, is one of the most efficient ways to execute that strategy, because it combines scalability with recurring revenue without requiring capital deployment into every location. You're not funding every unit, you're funding the system, and you're collecting on the growth. And when you layer equity into that, it becomes even more compelling, because now you're not just participating in cash flow, you're participating in the value of the brand as it scales. And when you do that across multiple brands, the math starts to change in a very big way. Imagine allocating capital into 10 different franchise brands, each one scaling to 100 franchise units, each one paying, say, $2,000 a month in royalties. That's $200,000 per month per brand, $2.4 million per year per brand. Now let's say you own 5% equity in each. That's $120,000 per year per brand across 10 brands. That's $1.2 million per year in royalty participation. And that's before franchise fees, before supplier economics, and before any exit multiples. And this is where the investor mindset separates from the operator mindset, because the operator sees one brand hitting 100 units and thinks, we made it. The investor looks at that and says, how do I replicate this across 10 brands? Because the real upside isn't in one outcome. It's in the aggregation of outcomes. It's in stacking royalty streams, stacking equity positions, and building a portfolio that compounds. Now, layer in infrastructure, because this is where it gets even more efficient. When you invest in one brand, you're effectively investing in a standalone operation. But when you invest into a platform that supports multiple brands, now your capital is leveraged across all of them. The same marketing engine drives multiple brands. The same sales infrastructure sells multiple brands. The same operational frameworks support multiple brands. So now every dollar deployed has a broader impact, and every new brand added increases the return potential of the entire system while diversifying risk. This is how you move from isolated investments to an integrated portfolio. And this is also why institutional buyers pay premiums for these types of structures, because they're not buying a business. They're buying a system with predictable recurring revenue across multiple assets. When you combine that with capital structures like funds, special purpose vehicles, and co-investment vehicles, it creates even more alignment, because now investors can participate at multiple levels. And this is exactly how Empire Franchising is set up, at the platform, at the brand, and at the growth capital layer. All of it is tied to the same underlying driver: royalties, scalable, recurring, and compounding. So when you think about where to allocate your time, your energy, and your capital, don't just think about your next deal. Think about the structure behind the deal. Think about whether it creates one stream of income or multiple. Think about whether it's dependent on one outcome or diversified across many. Because the highest level investors don't chase deals. They build systems that produce deals, and they build portfolios that produce income. And franchising, when structured properly, gives you a direct path to do exactly that. So if you want to go deeper into how we structure these portfolios, how we align equity, and how we build platforms that generate multiple streams of royalties, go to empirefranchising.com. And if you're serious about thinking like an investor, not just an operator, subscribe to this channel, because this is what we're focused on: capital allocation, portfolio construction, and building real ownership at scale.